Hello and welcome to Sunday evening on the Shortfall Show. My name is Dave, and it's been a kind of a bad week last week for me. You know, I got all caught up in trading this Tesla stuff, which was kind of ridiculous. I probably shouldn't have done it, and then I was in this short. And then I lost a little bit of money. And then I just started getting stubborn. I was like, I took it off, and then I put it back on. I took it off, and then I put it back on. And I said to myself on Friday, look, I just got to get out. I got to get out of this. It was handcuffing me. I mean, I was sitting, staring at the every tick on the chart, just rooting for this thing to go lower. And, I had no real good reason to be shorted or anything. It was just ridiculous. And, I guess you could say I traded it well and that I covered my short down here in the low of the day. But still, what am I doing? Gave up, a little money on Tesla last week. Anyway, so after finally covering my position and swearing off of trading Tesla anymore, I put another position on Tesla. And this time what I did was I put a condor on. So I have this condor on. So I need Tesla to stay in a certain range. Let's see if we can pull up the risk profile for Tesla here. Oh, I have another little trade on too that's kind of coming up on the risk profile, but look at the risk profile here. So essentially, and the numbers are a little wacky, so, but essentially, you can see these edges here, the break-even points really, and, if Tesla just hangs tight in this range, within this $100 of where it is now for a little while, then I'll collect money every day. And if it starts to rip one way or the other, then I've got problems. But this should be a lesson to everybody. Don't just jump into things because it looks exciting. I'm kind of embarrassed by my trading behavior a little bit, but it is what it is, and hopefully you can learn something from maybe not doing what I do or something like that. But anyway, let's look at a chart of Tesla just out of curiosity here. This was a stock that went way up in the last week or so. Now, see, when I look at a chart now, it even looks kind of ridiculous. Why would I suspect it's going to stay within $100 of right where it is right there? I mean, it's been moving like crazy. Seems kind of arbitrary to expect that it would stay right around that area. It looks from this chart like it's going to rip one way or another, right? I mean, that's what I think. So I'm going to watch this position very, very carefully. And probably just bail out of it at the first sight of trouble. But let's talk about the VIX, and let's talk about the markets, and let's talk about the futures, which just reopened. So here are the here's a chart of the E-minis, and here is a chart of the futures since they reopened a few minutes ago. And we got a slight, not much. This is only within a 10-point range here. And we got a slight rally and then sort of sell-off, but pretty much down 4 right now. So compared with the action we've been having sort of recently, down 4 seems to be pretty much unchanged. And the VIX futures all up a little bit. Hi, Moldenite. Why was it so high? I'm a complete beginner. I was looking at UVXY's price back in 2015. Why was it so high back then? Thank you for your question. I appreciate it. And I have a great answer for you. The reason it was so high back then is because UVXY is a product which decays over time. And the best way I can put it to you is like this. It's kind of like when you buy UVXY, it's kind of buying insurance against a crash. And so if you buy it and a crash doesn't happen, you lose a little bit of money each day that the crash doesn't actually happen. So if you if you're to buy UVXY as a protection against stuff going lower, the price you pay is that it loses a little bit of its value over time. It's kind of like an insurance policy. If you want insurance that your stocks are going to be protected in the event of a crash, it's going to cost you money every month. And it's the same kind of thing with UVXY. Now, UVXY, although it's listed next to stocks and it's treated by a lot of people on StockTwits or otherwise, they treat it like a stock. They look at technical analysis and charts of it, but it's not a stock. In fact, it's very far away from a stock. What UVXY actually is it is an average of two futures, right? There's all of these VIX futures. There's and I have them listed on the left side of my screen over here. Let's see if I can kind of blow that up a little bit. And every day, the mix of the futures that UVXY is made up of switches. So ultimately, I'm getting back to your answer here. You can see the futures right there. I have them listed on my chart. So it will eventually hit $1 to $2. It will not hit $1 to $2. The reason it won't hit $1 to $2 is they will reverse split it before it hits $1 or $2. So what's happened many times before is UVXY has gotten down to like $7 or $8, and then they reverse split it. So when you look at a chart and you see, when we pull up this chart for like years and you see it up at like 10,000, it was never at 10,000. It was like, it went from like 60 down to 10, and then they reverse split the stock so that when you reverse split the stock, if let's say UVXY went to $7 and they reverse split it 5 for 1. So they would multiply the price of the stock by 5, but each share would be worth less. So what happens is the stock goes down from like 60 all the way down to like $5. They reverse split it, bring it back up to $50, and then it comes back down again. And it keeps going lower, but every time it gets closer to $1 or $2, they reverse split it. So it's heading towards zero over time. It's constantly heading towards zero. And interestingly enough, we haven't had a reverse split in the last year. With UVXY, in 2018, or at the beginning of 2019, they changed the formula for it. So it used to be a 2 times leverage product. Now it is a 1.5 times leverage product. And the reason that that's of interest to you is the less leverage you have on a product, the less it decays. And that's a certain kind of decay that I like to refer to as beta drift. But if you've got like a UGAZ or a JNUG or any of these products that have a lot of leveraging on them, they decay over time because of rebalancing. At the end of every day, they have to rebalance it to represent that leverage, and that constant rebalancing tends to decay the product. That's a certain type of decay. There's a separate type of decay that only affects, well, pretty much. It can affect other things like oil, but it has the biggest effect on VIX products, and that is the decay from the futures being in a certain shape that we call contango. So if we pull up the chart, I have a chart here that compares the futures to one another. People will recognize this. And when you look at this chart, what do you see? You don't see much because A, I'm in the way, and B, I sized it completely wrong. So let me fix that. When you look at this chart, what do you see? Well, you see the price of the futures that are closer to expiring, the February future, right, the beginning there, is a lower price than the March, which is lower than April. That price structure is called contango, and it results in this particular product. It results in it decaying over time. So we've got this number at the bottom of the chart. It says 1.3%. That's 1.3% per month that this is losing value. Now, when there's conditions are a little different, we can get up to 10%, 20% per month that this is decaying. And thus, when you read a lot of like ETF prospectuses, they're like, this product is not appropriate for all. This product is not appropriate for all investors. Blah blah blah. This product is not supposed to be for long term. Well, this is especially true with UVXY because it decays over time. And this is a kind of a well-known thing about this. And people get in their mind every once in a while like, well, maybe it's going to turn around and it will go back. And it's going to be some sort of like dries type thing where like it goes back to 100,000. But the thing is that the futures that we're trading when it was way up at those prices are long gone. They expired. They're long gone. And there's actually no market conditions which could get UVXY back up to where it started. You could see it spike up a little bit. You could see it like double or triple in value from where it is right now, but there's no conditions that could get it as high as it started. That is due to the fact that it would have to, for it to continue to move higher, the market conditions would have to be such that the Dow and the S&P would actually go to zero before it could get back up high again. It can't get all the way back up even if there's a big recession because the futures would have to, it would have to be like a continuing accelerating to the downside. And the problem is that if you get acceleration to the downside for any period of time, it gets down to like below 50%, 40%, 30%. And it just doesn't work. The reason it was able to get so low is because of a continued period of sort of calmness in the markets and stuff incrementally moving up. It doesn't work in the reverse way because the way the structure works, backwardation, if you stay in backwardation for an extended period of time, it means the market is continuing to sell off and continuing to accelerate selling off. And thus, before you could get back to anywhere near where it started from, we'd be below zero in the markets. And as we know, there's no limit to how high the markets can go, but to the downside, they can only go to zero. So that's why it can never get back to where it is. And it is interesting. And the thing is that, if you do buy UVXY, you could, if you timed it just right before a crash, you could make 100% on your money. I mean, you could make 200% on your money. It could just really explode. But usually what happens is it just kind of moves lower. So I don't generally advocate people getting long this for more. My rule of thumb is don't get long UVXY for more than 48 hours at a time. If you've got inside information that there's going to be a crash and you just really feel strongly that you need this sort of protection, it's probably not the most efficient way to protect a long portfolio either. But if you really need to feel like you're buying volatility and you really think something's going to happen, I would give yourself like a 48-hour window. If it doesn't happen, I would get out and then kind of reconsider your situation. Just because it tends, a lot of people will, buy this initially and then they're kind of like all of a sudden it's slowly moving against them and all of a sudden they're in the hole a bunch of money and they're asking us, well, what should I do now? And I just don't want you to get into that situation. Oh, yeah, no problem. That's what we're here for. So the question is this viable to short right now? Because like we said, contango's only 1%. Not that much has been going on. The market hasn't really been rallying that much. Let's take a look at the E-minis for a second overall. And I use E-minis as just as a proxy for the market. And we can see not that much because I'm in the way. But if I move out of the way, we can see Still not that much because the chart's not centered right. But let's go to 20-day. And we have sold off significantly as the show happens right now. Currently, E-mini's all of a sudden down 17. So we've got a big candle right here just in the first little while. We'll see what happens continuing. But you can see the market's been kind of sideways to down lately. So I'm not real interested in taking a big short volatility position right now. I kind of want to see what happens. The VIX is kind of in a mid-range to me. Let's take a look at the VIX here. And, whereas we don't necessarily like to use technical analysis with a lot of these ETPs, the VIX is a little bit different because the VIX just oscillates up and down. It doesn't decay. And if you look at that time period, it looks like we're in a mid-range. And if I back the time period, all right, so that is a 3-year chart, and it looks like we're right in the middle of it. Now, we're certainly way higher than we have been in the last 6 months. That's not a 3-year chart. There's a 3-year chart. It looks like we're kind of in the middle of things here. Now, if the market goes back to rallying again and we go back into rally train, then this could be a good shorting spot. And it's definitely a better shorting spot than it was like a month ago. But it's kind of unclear what's going on with the market right now. And I don't want to be too big either side of this trade. And I currently don't have any sort of short on, but this isn't really about what I have on, it's about what you have on. And certainly a lot of the tactics that we've been talking about over time will continue to work, such as the Bullseye strategy, which is essentially looking at just selling at the money calls in a UVXY. And right now 1174, as UVXY moves lower and lower below 10 and stuff, it feels like these things have less premium in them. I know a lot of people are still doing this strategy, but so for example, if I look at the front week and it's showing 5 days to go here, you could sell maybe the 12 calls for 55 cents and hang out, see what happens. If this call is out of the money, then you collect the money at the end of the week. If it's in the money, then you could just take this short call and roll it out to the next week and just hang out like that and just collect. You're at the point of maximum decay and it's going down eventually, and so you could just keep rolling a short call out. Now the risk with this, of course, is that you have to consider this. If you sell a naked call in UVXY, you have to consider for each call you sell that you're essentially shorting 100 shares, because for risk purposes, that's essentially what you're doing, because this is going to act like, although it's acting like a 50 delta option, although it's acting like a 50 delta call, it's actually you're giving someone else the right to buy 100 shares from you at the price of 12 if you're selling this call. So for risk purposes, you have to think, am I comfortable shorting 100 shares of UVXY? We know that if there's a big spiky spike, that this could go, I don't think it's very likely that it could go to 50. It could if things are extreme. But you just want to manage your risk and look at, where would I be if I was short 100 shares of this and it went to 50? Would it be a situation where no big deal, I still have, millions of dollars in my account? Would it be a situation where Interactive Brokerage is trying to get a hold of you and they're like, you're going to need to deposit another 20 grand in your account? You want to consider the worst case scenario when you're selling naked calls in these products. And it's something that you really want to understand it well and feel very confident in your understanding of things before you sell naked calls. And you see people doing it, and it's something I would consider personally, but I would consider doing it very small. Next, let's look at the strategy I was employing like a month ago, which was VXX, buying junk puts in VXX. So if we go to VXX here, what I was buying back then was I was buying the Jan, which are about a year till expiration, the 7 puts. So if we look out to Jan here, as the E-minis seem to be stabilizing here down 16. So if we look out to Jan, these puts pretty much haven't moved. Let's see, market's 45, bid at 56. That's a pretty wide market, but they're right around, they've been hanging out around 50 cents, really. And, but, think about, when I look at an option like this, you just want to think about how likely is it really that this makes a 50% down move in the next year. Now, it doesn't have to make a 50% down move in the next year for you to make money on this trade. It just needs to make a nice down move that's faster than what is costing you in decay every day, and you'll make money on this option. But I don't like these trades as much now that the term structure is so flat. When we were at like 15% contango, that's something different. But now we're at 1% contango, it just doesn't seem as inviting to me. And this market, now that we're off of the rally train for a little bit, it just seems, I don't know. I just don't like the setup as much. It feels like we could get a down move here in equities at some point. So I'm kind of being careful. What do you guys think? We're going to have some special guests coming on. Not today, but sometime this week. Hopefully, if all things work out well. I was watching Elon Musk on that when he came on Joe Rogan. I was at work was trying to get somebody into Joe Rogan. I like Joe Rogan in that he's politically neutral, and I guess he's come out endorsing one candidate, which is upsetting some people. But in general, he's been relatively politically neutral, and he's been able to have guests from both sides of the aisle, which is a good deal. Because it exposes everybody to the other side. I think it's unfortunate these days that, like, at least in the U.S., people pick one political party or the other, and they don't really allow for to have their mind changed. And so they pick one side or the other, and it's this tribalism thing, us against them, and it's really tiresome. And, when you listen to somebody from either side of the aisle state the party line, I don't think it's clever to state the party line. I could pretend I was one side or the other and state the party line, and it's just kind of boring to me. But you talk about politics at all, and people get all ruffled because 50% believe that they're totally right, and the other 50% believe they're totally right, and it's very I don't know, it's strange. Like, a lot of the country doesn't care that much about politics, but the people that care about it think that everybody cares about it. Like, for example, my folks they think that everybody on the other side of the aisle from them is as extreme as they are. It's kind of strange. You're going to wait for the next spike to short volatility. Yeah, I just don't see the risk reward right now just doesn't seem great to me. And you know what I've learned in the trading world is that if you hang out, if you have, cash in your account, you're ready to go, and you hang out long enough, a trade's going to come along that is a layup, and you feel it. You're like, I know this is a layup. This makes sense. Let's do it. And, sometimes just being patient and just sitting on the sidelines, I go through my mind, and I think about, what if scenarios. And I've had several times where I've lost a bunch of money, and you think to yourself, you can have money in your account and you can be frustrated because you haven't been making money, but it's better to have it on the sidelines and not be making money than to just give it away and lose money. I mean, the first thing is just to hold on to what you've got, and it's such an important thing. And yeah, it seems sometimes it's frustrating that you hear people are, the grass is greener, somebody over there is making money on this or that. It's always going to be like that. But, your first thing is to conserve what you have so that you're in the game. And I can't really say enough about that because especially for me right now, like for me, when I was working as a market maker, I had mega expenses. Um, seat lease. You had, when working as a market maker on the floor, you have to lease a seat. And it's kind of like a taxi medallion. You can't trade unless you're on the seat. And the most expensive I ever paid for a seat was $12,000. I think it was like $12,000, or maybe it might have gone up to $15,000 a month. And when you're paying $12,000 a month just to stand there, plus you've got office expenses, clerk expenses, et cetera, technology expenses. It goes on and on. The pressure is on. But in this day and age, you've got a TDAmeritrade account set up or a Schwab account set up, and it's not costing you that much to just have your cash in there. In fact, it's relatively free. And there's an opportunity cost. I mean, if you're sitting in front of the computer trading, you could be off doing some other job or something. I'm assuming a lot of you have other jobs besides trading. But the point is that the costs of just parking your money and being patient are not that high for most people who are watching the show right now. And so I guarantee it feels like you miss something sometimes, but I guarantee there'll be another opportunity. I'm sure when we talk about Tesla, there's people out there, if you watch the Tesla chat room last week, those days where the stock was up like $200, there's people there who are just, like the massive bravado and bragging. And of course, traders are alpha people, and you, in a sense, you can't execute well unless you believe that you're right and that you know what's going on. But people were just really craziness. There's craziness in the chats with Tesla when it was up $200. People were like, I made so much money, I'm a millionaire, and my bleep is bigger than yours, and all this kind of stuff. And people would do crazy things when they it's that whole fear of missing out thing. They do crazy things when they see or that there's a perception that other people around them are making money and they're not. Sometimes it's best just to turn off all of that stuff. I definitely feel the value of chat rooms and YouTube and all these other things, because it's going to, first of all, highlight you as to what's going on during the day and things like that. But sometimes you just got to turn it off, because it doesn't help me individually figuring out if I have a position on Tesla. Reading the chat midday when stuff is moving around is not going to add any value whatsoever. In fact, there's definitely a case to be had that most people on StockTwits are going to be saying the opposite of what you should be doing. But there's some value in looking at that too. If everybody says up, maybe it's down. Here it's funny. Let's just look at some of this Tesla right now. One thing is saying, oh, definitely buy it. The other people are saying, oh, it's gapping down. So one person says it's gapping up, the next says it's gapping down. Futures are down, not up. Why are futures down? And the other thing with Tesla is, like, for Tesla to go higher from here, that means somebody has to commit new money, either money that they made on the initial move and then they got out of their position and they're buying back in, or somebody has to buy new money or somebody has to, people have to come in and think it's definitely going higher from here and to buy for it to move higher now. And I know that's kind of seems like an obvious point, but how many people would want to buy a stock that's already up like 50% from where it was 6 months ago? Once again, I don't have an opinion either way on Tesla, and I'm staying out of it. I'm looking at the chat on StockTwits, and people are saying, why is the market down? Maybe we can take a look at, I like a Dredge report to see breaking news. It doesn't seem... like there's anything like specifically breaking right now to make the market move lower. In fact, we've come off the lows that we were on. We were down 17 the E-minis. Now we're only down 12. So it doesn't seem like there's a whole lot going on right at this moment here. That's a good time frame to kind of illustrate what's happening right now. We're off the highs of last week, but this is the story of January for us. It's kind of a sideways market, really. Let's go back to Drudge and see what they've got to say here. You guys following the primary stuff? I'm not really. I thought that was funny. If you follow me for any period of time, you'll know that I'm sort of like I'm more like leaning to the left than to the right. But there was a funny thing. They had like the count from Sesame Street. They're like, we've sent an expert at counting up to Iowa to count the ballots, and they had the count from Sesame Street. I thought that was kind of funny. Here he is. I don't want them to. I have to be really careful to get banned for like showing someone else's content.
It's time to answer that fascinating question. What is the Sesame Street number of the day?
They had this guy. They're like, they're sending an expert to count the ballots up in Iowa. I thought that was kind of funny. But yeah, I mean, not surprising that Biden fell back as far as I'm concerned. Wow. Birds of Prey, worst opening in a decade. Oh, that's interesting. I thought that movie would do kind of good. I like that actress. What's her name? That's too bad that it didn't do well. Oh, well, it doesn't matter. Whatever. They're all rich anyways. They've got way more money than we do, so she'll be okay. She'll make it somehow. So, so I've been watching The Outsider. I don't know if you guys are into that. Stephen King on HBO is pretty cool. I'm going to start watching the show The Stranger. It's another one on Netflix, which is kind of interesting. I don't know if you guys have seen that. Then I watched there's a new Ted Bundy one out on, I think it's either it's one of them. Actually, it's Amazon, the new Ted Bundy one. It's his girlfriend, Liz, and it's all about like her side of the story and everything. It's kind of interesting. Yeah, so E-mini's kind of stabilized here. Doesn't look like a whole lot's going on. We've got the front month futures up 42 cents. So just kind of extrapolating from what the futures are doing, I would say that if the VIX were to open right now, the VIX would probably open up at least a point, I would think. Seems like we've just been in this mid-range for a while. We'll have to wait and see what happens. Yeah, so there it is. If you guys don't have any specific other stuff you want to talk about, I think we'll leave it there for now. And it's kind of fun. I kind of like checking out the open of the futures on Sunday night because guess what? Like for me as a trader, sometimes I'm able to like forget about trading for a little bit or at least step away from it for a little bit over the weekend. But as soon as those futures open at 6 p.m., I'm back on it. Any particular reason you prefer TD Ameritrade? I prefer TD Ameritrade because I love Thinkorswim. I think it's a great piece of software, and I was over when I first came back to trading again. I didn't have the minimum to trade in interactive brokerage, which was $10,000, and I went to Tastyworks and I said to TD Ameritrade, I found somebody else that was getting lower commissions than I was, and I said, can you please match this other guy's commissions? It wasn't a really like hardcore, like it wasn't a huge size trader either. He was trading about the same volume I was, and he was on TD Ameritrade, and he had better commissions than me. So I said, can you please match way he had, and they were kind of giving me a hard time. And so I said, all right, I'm leaving. I'm going to Tastyworks. So please match Tastyworks, and I'll come back if you match Tastyworks. And Tastyworks is great because you don't have to pay for closing trades. But at the time, I was trading a lot of MJs that were based in Canada, and Tastyworks, you couldn't get access to the Canadian market. So it was a big problem. The other thing with Tastyworks is the day I switched over there, I was selling naked calls in UVXY. And the day I came there, the next day they changed the margin requirements for selling naked calls. So I might have been one of the, I don't know, maybe I'm putting too much importance to myself, but it just, one of the reasons I went there is I compared. TDAmeritrade has kind of like an extra, a lot of these firms do, it's an extra margin requirement to short VIX calls, to UVXY calls, compared with like just a quote unquote regular stock calls. And basically, I compared as much as pricing for options and pricing per trade, it was also just how much money were they making you put up to have risky VIX positions, to sell naked calls, and etc. And all said and done, Tastyworks was cheaper, and they had the same kind of amount of money you had to put up. But as soon as I switched over there, they made it like you had to put up double to trade UVXY or something, and once again it made it not worth my while. And fortunately, TDAmeritrade went ahead and matched Tastytrade's rates, and so like I said, I would come back if they did that, and they did that, so I came back. So I would recommend, though, to you, viewer, that you have more than one account for trading. Now, you can have like $1 in the other ones or something, but but if you have more than one account, then if you get into a fight with one of the other brokerages, which I know sounds kind of crazy, but it definitely does happen, or something goes down, their system goes down, I don't know, a whole bunch of things could happen to make it so that you needed to use another brokerage. I would have another one on hand to jump over to. I have, and a lot of us have a separate brokerage that we're using for our 401k or something like that. For me, I'm in New England. The companies I've worked for, the 401ks are out of Fidelity. I also have other stuff through Morgan Stanley. And so I have a couple different ones that I'm on that I can trade options on that I can jump back and forth to. If I start fighting with one, I can switch to the other. And I'd highly recommend that you consider that as well, having more than one brokerage account, just in case, something happens and you need to switch over. And once again, the brokerage business is always trading, always changing. And you should be out there trying to get your rates lowered all the time. Now, it's a great thing that they've made stock trading free in almost every brokerage. Yeah, I think E-Trade is certainly a viable, I was going to say option. It's certainly viable as well. And I don't know it as well as I do TDAmeritrade, but I've always heard good things about it. I have my friend's brother is head of options trading for TDAmeritrade, or he's a bigwig there, and I know some other people there. And I certainly think I certainly have nothing against E-Trade, and I think if you're there, you'll do fine there. There's not that much difference between all of these companies right now. There's Schwab as well. I like Tastyworks just because I kind of know the guys, and they all come from the SIBO, which is where I came from too. So I like Tastyworks. I want to support those guys. I see them as like the little guy against the big guys. And I'm just looking back through the chat, and I see, Dave, what's the lowest price you bought your Jan 7 puts for? And I did buy some for 43 cents. It was the lowest price I bought the Jan 7 puts for. But I've actually, I've done really well on those. I think that's the lowest. I did really well on them at the end of the year last year and made some good money with them. So, but I've had some times where like I bought them for, I did something like bought them for 45 and sold them for 44 or something like that. I mean, I've had some nice positive scalps, but I've also had some negative scalps. The other one I was trading was the SEP7 puts. And the thing is, here's the thing. If you're going to trade VXX puts, it's kind of counterintuitive in that if you want to make money on them, it's almost best to buy them when not that much is going on. Because when stuff is jacked, like when there's a spike, they take the prices up so much that it's almost not worth it. And my best luck with it was when we were just in maximum contango and we were rolling down every day, and I jumped on then when like the option prices were pretty low. Do you have any reference guides for beginners? Are you talking about? I not to be insulting at all or anything like that. But are you talking about for options or for VIX specifically? Because for options trading, I would check out Option Alpha with Kirk Duplessis's site. He's really good. It's almost all free. Tastyworks also has a whole bunch of stuff, which is almost all free. Let me just write these in here. Tastytrade. Trade videos, Option Alpha. My friend Brent on Money Talk, which is a YouTube channel, Money Talk, has a series on like just the basics of option, buy, call, buy, put. What's a vertical spread? What's a straddle? What's a strangle? It's not super hard. It takes just repeating the concepts over and over again a few times for you to get it kind of understood a little bit better. I would check out Option Alpha. If you're serious, wanting to kind of develop your skills, and you want one-on-one, like I don't know if you're seriously want to be trading stuff and you want to get up to speed and like money's no object. Once again, I don't know your situation. You could check out Option Pit, which is you could go on there and they would give you one-on-one treatment where you could get lessons from them. Where they would meet you on Skype and go through it with you. The other one is another buddy of mine from the SIBO. Now, this guy, we reconnected like 2 years ago, and he actually, I guess he was standing behind me in the pit when I was in Xilinx or something like that, and I guess he was clerking, and then he left the floor and made this good career out of teaching people how to trade. And I'm just going to put his stuff up on here. Jacob Mintz. He's another guy who, who will meet up with you and can walk you through some stuff. Also, I would just point you to the options group that. Now I don't. This isn't like quote unquote my group. I'm a mod for it, but pretty big size group on Facebook that you can pretty much come on any time of the night or day and just ask a question, and they will be able to answer it for you. And certainly, if you have some sort of question like, oh, expiration's coming and I don't know what to do on this. Let me give you a link to that. So here's the Facebook group for options trading. Let me give you a link to Brent's channel here. Stay with me just one sec. I'll give you that link. And then I'm going to call it a day, I think. Stay with me. Let's see. Brent's channel. Yeah, just he has a series on just each individual option strategy and the kind of the basics of it. So let's give you a link to his channel here too.
Welcome everybody to Volatility Trading.
Oh yeah, he we all change the names of our channels all the time. I don't know, it's kind of an annoying thing, but I do it too, so I can't really fault him. Yeah, excellent advice. Macmillan, options as a strategic investment, and then Shelley Natenberg, options. What's it called? Volatility and pricing. Look up the author Shelley Natenberg. These were two, like, Macmillan and Natenberg were two books that I was given like my first day as a runner on the floor of the Chicago Board of Options Exchange. I was told, and Macmillan, it's a little dry, but it's got all the information that you need. The basic strategies. Essentially, options trading is like a half a year of like a college algebra course. It's that much material. It's just a little bit of math material that you need to go through to get where you need to be, and that's a great advice to check out the Macmillan book, because that is it's really just standard fare for any options trader. Here's the other one, the Shelley Natenberg book. I'm going to see if I can put this on the screen. I don't know if this is going to work or not here, but let's give it a shot. No, that didn't work. Shelley Natenberg. And Shelley Natenberg was a trader on the floor at the SIBO as well. Anyways, just type Shelley Natenberg into your browser. It's not coming up. This is what it looks like. It looks like that. And he's going to talk about, because with options trading, there's the mechanics of options trading, but in the end, what you're trading is this stuff that's, there's an amount of, the price of options can go higher or lower, and that amount above over parity, they're called, or we call it fluff, moves, and it moves based on how volatile a stock is and the volatility and changes in volatility. And for a professional options trader, in the end, we're focused on what is the volatility level of a particular stock. Is it higher than the average for that stock? Is it higher than the average for that sector? And as in the end, options trading, calls and puts, a professional trader would see them almost as the same thing, in that you either own a certain strike. A strike would be like a certain price level. So you either own in Tesla the 750 strike, or you're short it. Whether you're short or long calls or puts is not as important as what your delta is and whether you're long or short it and how much it's costing you per day. And so Macmillan book is going to go through the mechanics of just there's things called synthetics, like if you buy a call and sell stock, it's the same thing as buying a put. If you buy a call and sell a put, it's the same thing as buying stock. There's synthetics. There's all these relationships involved. But Natenberg is going to talk more about volatility levels and how you make money trading the actual volatility, which is what is what's really the changing in pricing in options. That's the real price level that's changing back and forth. All right. Sorry to get off on a tangent there, but hopefully I think this is information that other people can benefit from, not just the person that asked the question, so that's why I did that. All right, guys. Thank you for watching me, and stay tuned. We are going to have some special guests this week. Have a great trading week, and if I don't see you before then, I'll see you back this time again next Sunday. So I certainly will be doing videos before then, though. So thanks for watching, and I'll see you out there trading.